My name is Charles Farmer. I'm the Director of Development for the Center for Excellence in Education. Glad that you could all join us. I want to introduce Mark Kantrowitz. He's an RSI 1984 alumnus. He is nationally recognized as an expert on student financial aid, scholarships, student loans, college savings plans, and education tax benefits. His mission is to deliver practical information, advice, and tools to students and their families so they can make informed decisions about planning and paying for college. And also, Mark serves as a CEE Trustee, and we're grateful to have him here with us. And Mark, I will go ahead and turn this over to you.
Thank you, Charles. So this talk is about FAFSA simplification. After summarizing the key changes to the FAFSA, we'll discuss who benefits and who doesn't benefit from the changes. For example, students in single-parent households will get more financial aid, while middle and high-income families with multiple children in college will get less aid. There's a new financial aid formula for the federal Pell Grant eligibility. The financial aid form and formula will change to better align the FAFSA with federal income tax returns. And there are also changes to the cost of attendance and financial aid appeals. The number of questions on the FAFSA is going to drop by almost 2/3. Some questions have been eliminated, while others will be answered by transferring data from the IRS. Transferring data from the IRS will now be mandatory instead of optional. In addition, intelligent skip logic may also reduce the number of questions that individual applicants must answer. So the number of questions has been reduced from 108 to 46. The question about selective service registration and drug convictions have already been dropped on the previous year's FAFSA. The U.S. Department of Education has published a roadmap for implementation of the new FAFSA, which states that the 2024-25 FAFSA will be released in December 2023. The exact date in December is not yet set. The delayed start is due to the complexity of simplifying the FAFSA and building a new platform for the FAFSA. They're not just changing the form, they're actually changing the underlying platform. The Consolidated Appropriations Act of 2021 devoted 167 pages to FAFSA simplification, so it's not an easy enterprise. The FAFSA will return to an October 1st start date with the 2025-26 FAFSA. The changes that benefit single-parent households include increases in the income protection allowance, otherwise known as the IPA, and greater eligibility for the federal Pell Grant. Financial aid eligibility will decrease for middle and high-income families due to changes concerning the number of children in college, the small business exclusion, and the family farm exclusion. Traditionally, the financial aid formula has focused more on income than on assets. There have been a few changes that shift the focus from cash flow to a slightly greater emphasis on wealth. In particular, the changes in the use of the number in college shifts the focus of need analysis away from cash flow. The new federal Pell Grant formula makes it easier to determine who will qualify for the maximum Pell Grant, as well as a minimum federal Pell Grant. Aid preparers can no longer charge for completing the FAFSA, except that a federal income tax return prepared by a paid income tax preparer may be used to complete the FAFSA. Let's talk a little bit about some changes in the form. The redesign of the underlying FAFSA platform will allow the U.S. Department of Education to increase the number of colleges listed on the FAFSA from 10 to up to 20. Parents who have an individual taxpayer identification number, an ITIN, instead of a Social Security number, and parents who have neither will be able to get an FSA ID to sign the form electronically. That's a major improvement since it allows more families to sign it electronically. FAFSAs are less likely to be selected for verification because of a reduction in the number of questions and because more data will be transferred directly from the IRS. This will help eliminate verification as a barrier to financial aid eligibility by reducing the number of times low-income students must prove that they are poor. There are several new names for old terms on the FAFSA. These new names are more descriptive, but do not make college more affordable or the FAFSA easier to complete. The term EFC, or expected family contribution, was misleading since many families incorrectly believed that the EFC was all they needed to pay. Most families paid more than the EFC. Most colleges leave students with unmet need, that they have to pay in addition to the EFC. Even when a college meets full need, financial need is met with loans. Loans must be repaid, usually with interest. A few dozen colleges replace the loans with grants, but these colleges often redefine financial need. For example, a minimum student contribution sets a minimum EFC greater than 0, even for low-income students. Now, the students will no longer be required to register for selective service to qualify for federal student aid. Students who are age 26 or older but did not register will no longer be required to demonstrate that their failure to register was not knowing and willful. However, men aged 17 to 25 are still required to register with selective service, just not to qualify for federal student aid. Since the question has been removed from the FAFSA, men will no longer be able to register through the FAFSA, and instead will need to do so at sss.gov or at the local U.S. Post Office. Congress has not yet addressed the ruling of the U.S. District Court for the Southern District of Texas, which was issued on February 22, 2019. This ruling found that requiring men but not women to register with the selective service was unconstitutional. That ruling was reversed by the Fifth Circuit Court of Appeals and appealed to the U.S. Supreme Court, which denied a writ of certiorari, deferring to Congress, which has yet to pass legislation changing the selective service registration requirement. After all, women now serve in the U.S. Armed Forces. Now, some states require selective service registration for a student to be eligible for state grants. 23 states require it for state grants, and 27 states do not. And the states that require it are slowly passing laws to end that requirement. But for now, you still have almost 24 states where if you don't register for selective service, you might not be eligible for the state grants. The suspension of aid eligibility for students who have been convicted for the sale or possession of a controlled substance while receiving federal student aid has been repealed. The questions about gender, race, and ethnicity on the FAFSA are optional and do not affect financial aid eligibility, such as the types and amounts of financial aid they receive. They were added to enable the analysis of aggregate demographic data. The U.S. Department of Education has said that the 2024-25 FAFSA will be available in the 11 most common languages spoken in the U.S., but has not yet specified the languages. It is likely that the languages will include English, Spanish, Chinese, Tagalog, Vietnamese, Arabic, French, Korean, Russian, Haitian Creole, German, and Portuguese. Other languages such as Hindi, Italian, Polish, Yiddish, and Japanese will be supported through the Federal Student Aid Information Center. Now let's talk about the increases of financial aid for single parents. Single parents include both dependent students living in a single parent household. The parents might be divorced or a widow or widower. They also include independent students who are themselves single parents. More than a third of dependent students have just one parent due to divorce, separation, never married, or death of a parent. More than a quarter of independent students are themselves single parents. The income protection allowance shelters a portion of student and parent income. The income protection allowance will increase for all students and parents, but it will increase more for single parents. For example, the income protection allowance increases by up to $2,400 for most students, but by $6,500 for students who are single parents. The poverty line thresholds for single parents are also higher. Now, there will be less aid for multiple children in college. The question about the number of children in college at the same time will still be included on the FAFSA, but will no longer have any impact on the student's student aid index, or SAI. Only 40% of families have just one child in college at the same time. About 20% of families have 1 year of overlap, about 25% have 2 years of overlap, and 14% have 3 or 4 years of overlap. Now, the income protection allowance was previously reduced by the number of children in college, since some of their costs were shifted to the cost of attendance. For example, in 2023-24, the income protection allowance was reduced by $3,610 per child in college. Dropping this reduction in the IPA will increase financial aid eligibility by up to about $1,700 per child in college. But this will be less than the decrease in aid eligibility due to the parent contribution no longer being divided by the number of children in college. The impact on low-income students is small, in part because many of these students already qualified for the maximum federal Pell Grant, and the parent contribution was very small. Some middle and high-income students who previously qualified for a federal Pell Grant will no longer qualify as a result of this change. For example, parents with six-figure incomes and multiple children in college at the same time might previously have qualified for a federal Pell Grant, but they are unlikely to continue qualifying for a federal Pell Grant. The current FAFSA, as opposed to the new FAFSA, focus on cash flow more than wealth, reasoning that parents who have two children in college at the same time do not have twice as much money available to pay for college. The new FAFSA changes this and will no longer provide families with any benefit from having their children overlap in college. This decreases aid eligibility significantly, especially for middle and high-income families who have multiple children in college at the same time. Some policymakers saw dividing the parent contribution by the number of children in college as a loophole that mainly benefited wealthy students based on the timing of the family's children. Let's talk about the new Pell Grant formula. The new federal Pell Grant eligibility formula combines the current formula based on the student aid index with a new formula based on adjusted gross income and a multiple of the poverty line. This is similar to other means-tested federal benefits, such as Medicaid. It depends on income below 133% of the poverty line. SSI is 75% to 109% of the poverty line. SNAP, otherwise known as food stamps, is 130% to 200% of the poverty line. TANF, sometimes called welfare, is 50% of the poverty line. WIC is 185% of the poverty line. LAHEAP, or heating assistance, is 150% of the poverty line. Lots of different multiples of the poverty line. Well, they wanted to create a new formula for the Pell Grant that was also based on a multiple of the poverty line because it's simpler and easier to understand. Now, although the income is based on the prior year, the poverty line is probably going to be the one that was immediately after that. Thus, eligibility will depend on the student aid index, the student's dependency status, adjusted gross income, single parent status, family size, and the federal poverty line. Still a little complicated, but in practice, it'll be easier for families to understand. The federal Pell Grant amount is equal to the maximum federal Pell Grant minus the student aid index, provided that the student aid index is less than 90% of the maximum federal Pell Grant. That's because the minimum federal Pell Grant is 10% of the maximum. An applicant with a 0 or negative student aid index is eligible for the maximum Pell Grant under this old formula. A student is also eligible for the maximum federal Pell Grant if their adjusted gross income is less than 175% of the poverty line. This threshold is increased by 50 percentage points to 225% of the poverty line for single-parent households. Now, the cutoff for minimum federal Pell Grant eligibility is 100 percentage points higher than the threshold for a maximum federal Pell Grant, except for independent students with dependents other than a spouse, where it is 175 percentage points higher. So lots of different thresholds. But in practice, this translates into simple lookup tables where you compare your income with a given income threshold and you're done. Again, the threshold is increased by 50 percentage points for single parent independent students. If a student does not have an adjusted gross income because they are not required to file a federal income tax return, they will be eligible to receive the maximum federal Pell Grant. The addition of this new formula on top of the old formula expands eligibility for the federal Pell Grant. More than 500,000 additional students are expected to qualify for the federal Pell Grant, and more than 1.5 million additional federal Pell Grant recipients are expected to qualify for the maximum federal Pell Grant. So this provides a significant additional amount of grant aid to many low-income students. I referred to lookup tables, and this lookup table is based on 2020 poverty lines, probably the 2024-25 FAFSA will be based on 2022 poverty lines, which are a little bit higher than 2020 poverty lines because inflation was so high. But what you can see is you look up what type of student you are: dependent, independent, you're single parent, whether you have dependents or no dependents, to get the exact row. And then you look up your family size. So if you're a family of 4 and you're a dependent student, it's 45,850. Same thing for an independent student with no dependents. If your income is below that threshold, you qualify for the maximum federal Pell Grant. If it's above that threshold, you look at the next table, which has, for the same dependent student, family of 4, it's $72,050. Same thing for independent student without any dependents. And if your income is above the previous threshold but below this threshold, you get at least a minimum federal Pell Grant. So students from typical families within a family adjusted gross income of up to $40,000 to $60,000 will qualify for the maximum federal Pell Grant. Students from typical families with family income of up to $60,000 to $85,000 will qualify for a minimum federal Pell Grant. Now let's talk about some changes in income on the FAFSA. Several types of untaxed income will no longer be reported on the FAFSA. Eliminating these types of untaxed income reduces the number of questions on the FAFSA. In particular, the elimination of the cash support question has significant impact. It means that gifts to the student and qualified distributions from a 529 plan that is owned by a grandparent, aunt, uncle, or someone other than the student or the parent will no longer have any impact on financial aid eligibility. Now, the third bullet on the slide about child support received, people think that's income, that isn't an asset. Why is it being reported as an asset? This change is strictly for the effect. Reporting it as income has a greater impact on financial aid eligibility than reporting it as an asset. As income, it could reduce aid eligibility by as much as 47% of the amount of the child support, whereas reporting it as an asset typically reduces aid eligibility by at most 5.64% of the child support. So this means that people who receive child support is going to have less of an impact on aid eligibility. Not sure why they didn't just eliminate it entirely, but they wanted to still count it in some manner. Now let's talk about changes in reportable assets. The small business exclusion and the exclusion of family farms from assets have been dropped. There is still going to be an exclusion for the family's principal place of residence, or the family home. Now, a family farm might still qualify as the family's principal place of residence if the family home is on the farm and the farm and the home are covered by a single deed. There is no longer a specific income threshold for automatic zero EFC or automatic zero student aid index. Instead, the SAI is going to be zero when adjusted gross income is less than 175% of the poverty line, or 225% for single parent households. There have been significant changes in the design of the simplified needs test. Starting with its name, it's now going to be known as applicants exempt from asset reporting. It's more descriptive, but also more of a mouthful. Applicants can qualify for the exemption from asset reporting either through the type of tax return test or the receipt of means tested federal benefits test. An income threshold is required for the type of tax return test, but not the means tested benefit test. The income threshold for disregarding assets is going to be increased from $50,000 to $60,000. Eligibility will be based on whether the taxpayer filed schedules A, B, C, D, E, F, or H, and no longer on Schedule 1. Now, with Schedule C, it's going to be if the gain or loss is greater than $10,000. If it's less, it will not, and the student will still be eligible. The means tested federal benefits include the Earned Income Tax Credit, SSI, SNAP, TANF, WIC, Medicaid, refundable credit for coverage under a qualified health plan, or QHP, the free and reduced price school lunch, and federal housing assistance. Unfortunately, the simplified FAFSA does not fix the disappearing asset protection allowance problem. The asset protection allowance, which sheltered a portion of family assets based on the age of the older parent, is now zero. It used to be as high as $85,000. Now, I rattled off a whole bunch of schedules. Let me describe what those schedules are. Schedule A is itemized deductions. Schedule B is interest and dividends. Schedule C is business income or loss. Schedule D is capital gains and losses. Schedule E is income from rental properties, royalties, partnerships, S corporations, estates, and trusts. Schedule F is farm income and expenses. And Schedule H is household employment taxes. And these are generally ways that people can manipulate their income, and sometimes involving paper losses as opposed to real reductions in cash flow. Now let's talk a little bit about which parent must complete the FAFSA. When the family relationship has dissolved, only one parent is responsible for completing the FAFSA. Otherwise, both parents must complete the FAFSA. Now, if the parent who is responsible for completing the FAFSA has remarried, the step-parent's information must be reported on the FAFSA, regardless of any prenuptial agreements. That's an agreement between the two spouses, not an agreement with the federal government, and the federal law is quite clear in that regard. Now, family size will now be based on federal income tax returns, which has a different definition of qualifying children and qualifying relatives. Children must live with a parent for more than half the year and must not provide more than half of their own financial support. However, temporary absences for school, military service, or other reasons do not affect whether the child is considered to be living with the family. But the requirement that the children live with the parent may affect whether the step-parent's children from a previous marriage can be counted in family size. Financial aid no longer counts as part of the student's own support, so this may affect whether graduate students count in the family size if they happen to live with the family. If the child is married, they must not file a joint return with their spouse to be counted in family size. So there are some quirks here. And children must be under age 19, unless they're a full-time student, which they must be under age 24. So there are quirks, but it's referring to the federal income tax return. So you've already determined whether or not the child is in your family size on your federal income tax return. So that makes it simpler in practice. Now, some details have yet to be determined. The new law provides the U.S. Department of Education with the authority to provide alternate procedures for determining family size when the student's household size or financial information has changed since the prior year, such as children born or adopted after the end of the prior tax year. This also includes divorce settlements with multiple support agreements. A multiple support agreement specifies which parent can claim the children as dependents on their federal income tax return. Parents who are getting divorced or separated should consider the potential impact of multiple support agreements on eligibility for need-based financial aid when drafting the financial settlement and child custody agreement. Now, if more than one parent could claim the child as a dependent on their federal income tax return, then the parent who is allowed to claim the child is based on the parent with whom the child resided the most of during the tax year, or if the child resides with both parents equally, the parent with the highest adjusted gross income. You might think, how can the child reside with both parents equally since there are an odd number of days in the year? Well, leap years have an even number of days, and recent divorces may have an even number of days. So this has some similarities to the old FAFSA definition of family size, although with inverted order. Now let's talk about changes to the cost of attendance. Now, some college financial aid administrators set the room and board component of the cost of attendance to zero when a student lived at home with their parents. This will no longer be permitted. The U.S. Department of Education will also be able to regulate the cost of attendance for the first time, except for tuition and fees. There has been some guidance in the past to colleges from the U.S. Department of Education. I would not be surprised if that previous guidance gets encoded into regulations and therefore becomes mandatory for the college. Now, Colleges can include other transportation costs, not just travel from school to home to work, such as conferences, field trips, medical residency interviews if they are part of the student's program of study. The statutory language is an allowance for transportation, which may include transportation between campus, residences, and place of work as determined by the institution. Now, some changes switch some costs of attendance components from optional to mandatory and vice versa. These include room and board, rental or purchase of a personal computer, an allowance for miscellaneous personal expenses, loan fees, and professional licensing costs. Colleges may include in the cost of attendance for less than half-time students any component that is not expressly prohibited by law. For example, co-op costs may be included, but not miscellaneous personal expenses if the student is has less than half-time enrollment. Now, the cost of attaining a license, certification, or first professional credential must be included, and it could be included more than one time if necessary. So it's no longer a one-time expense. And it can be either the actual or the average cost. Now let's talk about financial aid appeals. College financial aid administrators cannot have a policy of denying all professional judgment requests, all financial aid appeals. Some colleges had a policy of denying all appeals or a significant type of appeals just to reduce their workload. For example, some community colleges would not consider appeals about a change in the student's income when the student quit their job to go back to school full-time. This caused the students to not qualify for the federal Pell Grant. Now, all financial aid appeals must be considered on a case-by-case basis. Colleges cannot limit adjustments to just data elements in the FAFSA, but must also allow adjustments to the cost of attendance when appropriate, like if it's a special needs disabled student who has extra costs or has high dependent care costs. Now, a new change is with regard to dependency overrides when the student's dependency status is switched from dependent to independent. Dependency overrides are assumed to continue from one academic year to the next for the duration of the student's college enrollment, unless there is evidence to the contrary. So previously, students had to ask for a dependency override every single year. Now they just do it once and done, so long as nothing has changed. College financial aid administrators can also rely on a dependency override at another college during the same or a prior academic year. Colleges must evaluate a request for a dependency override within 60 days of the start of the student's enrollment. So longer delays are not allowed. Now, during a disaster, emergency, or economic downturn, financial aid administrators may set the income earned from work to zero if the applicant can document the receipt of or application for unemployment benefits within the last 90 days. This used to be optional only if authorized by the U.S. Department of Education. During the pandemic, Secretary DeVos didn't authorize it, whereas the Secretary Cordero did. It's now going to be mandatory, something that doesn't require the discretion of the Secretary of Education. Financial aid administrators can use other documentation besides application for unemployment benefits if there's no conflicting information. So maybe they applied for unemployment more than 90 days ago and they're still receiving unemployment benefits. So this encodes the guidance from what was called a Dear Colleague letter into law. Now, if a student's parents refuse to complete the FAFSA, the student can get unsubsidized federal direct Stafford loans, even if the parents do not cut off financial support to the student. Previously, they had to cut off the support, but the student will not be eligible for any other federal student aid, not the subsidized loans or the Pell Grant or federal work study, only the unsubsidized federal student loans. Now, emergency financial aid will no longer count as estimated financial assistance when it covers a component of the cost of attendance. Previously, if it covered a component of the cost of attendance, the emergency financial aid could reduce the student's aid eligibility, reducing their other financial aid awards. Now, emergency aid for other purposes might still count as estimated financial assistance, and reduce aid eligibility. However, it helps that the cash support is no longer reported on the FAFSA. So, and examples might include replacing or repairing a car, posting bail, medical, dental expenses not covered by insurance, and so on. So now we'll open it up to questions.
Thanks for the presentation. We only have one kid, so we haven't been through this before, and honestly, it confuses me, all the terms. And I've been trying to learn them. Do you have any like typical situations that would, or rules of thumb like, oh, don't even bother applying if your income is above this limit? Or I've heard colleges say the worst mistake you can make is not even applying.
You should apply for financial aid every year, even if you got nothing other than loans last year. And the loans are still pretty good. I mean, they're low interest, payments deferred while you're in school. They offer flexible repayment plans, deferment and forbearance plans, as well as discharges. But it's very hard to predict whether you're going to be eligible for financial aid other than loans without applying. So you really should apply every year. It takes only about half an hour to complete the form. It may take even less time with a simplified form. So it certainly is worthwhile to do so. I suppose if you earn more than $350,000 a year and your child's going to an in-state public college, then maybe you don't need to file the FAFSA, or if you could pay for college with pocket change. But even families that consider themselves middle income or even high income should probably apply. And the federal student loans are a good way for the student to have skin in the game, because they're not likely to overborrow on just the federal student loans. They have to borrow private loans or parent loans, then there's a good chance they're borrowing too much money. But if it's just the federal student loans, they're probably okay.
Thank you, Mark. I want to ask another question that was submitted in advance by a parent. And that question is, if I am not paying for my child's college, does my child still list himself as a dependent student?
The answer is yes. A student is a dependent student if they're not considered an independent student. And there's a set of a dozen or so definitions, 13 definitions. If the student is married, has children or dependents other than a spouse, is a military veteran, is an orphan, is serving on active duty in the U.S. Armed Forces, is a graduate student, then they're considered to be an independent student. Anyone who is not an independent student is a dependent student. And even though the parent may not be financially supporting the child may be living on their own and earning their own income, they're still going to be considered a dependent student, at least until they turn age 24.
Thank you, Mark. Does anyone have any other questions that they would like to ask?
If you don't mind me asking another question, I have heard other parents suggest that if my son is if your child is under 18, you can proactively emancipate them and claim they're independent, and that will get more financial aid. That seemed risky to me and something that's really an oddball suggestion. But the financial aid also may not come in loan. It may come into work study that the college suggests that the student get a job, which will, I'm not sure if I would want my kid to, if he's like already struggling with school, to actually have another time commitment on top of that. Yeah, those are two, I guess, separate questions.
All right, so let's deal with the second question first. Federal work study is optional. If you're awarded federal work study, you can get a job or not. If you turn down federal work study, your other aid does not increase. Federal work study is generally less than 12 hours a week, and it may also count for credit, not just cash. Research has shown that students who work 12 hours or less a week are actually more likely to graduate than students who work no hours a week. The hypothesis is that it forces them to learn time management skills. On the other hand, students who work a full-time job are half as likely to graduate within 6 years. Now, with regard to emancipation is a legal process, must be court-ordered, in which the student becomes an adult through that legal process. And it must occur before they reach the age of majority for their state. which is 18, 19, or 21. However, there have been a lot of sham emancipations or legal guardianships is another variation on this. If the student is still being supported by the parents directly or indirectly, living at home, parents are paying their expenses, the parents are paying the student a salary, it's not going to be considered, the student's not going to be considered an independent student, and may even be referred as a fraud case. There was a ProPublica story in the Chicago area where they uncovered a whole bunch of families doing this, and it was just a form of fraud. I mean, legal emancipation is very rare. It shouldn't be seen as a way to get more financial aid.
Thank you, Mark. I have another question that was submitted in advance, and that question is, can I get financial aid for multiple bachelor's or master's degrees?
So some types of financial aid are limited to the first bachelor's degree. For example, the federal Pell Grant eligibility ends as soon as you receive a bachelor's degree. Now, if you're double majoring and going to get 2 bachelor's degrees, it's important that you not finish one ahead of the other, because then your eligibility for the Pell Grant will end. On the other hand, federal student loans, the eligibility remains even after you get your first bachelor's degree, up to the annual and aggregate loan limits. Now, if you get your bachelor's degree and then you go on for a graduate degree, there are new loan limits that apply to graduate degrees that are actually higher than the loan limits for undergraduate degrees.
Okay, very helpful, Mark. I'm going to go ahead and ask another question submitted. Should I fill out the form if I'm a DACA student?
If you're what? Oh, a DACA student.
DACA, yes.
All right. So DACA students are not currently eligible for federal student aid. However, they may be eligible for state aid and financial aid from the college. I would suggest talking to the college financial aid administrator to ask what they want to do. There's a way to signify on the FAFSA that you're not a U.S. citizen or permanent resident or eligible non-citizen, which is things like asylum seekers. And then that gets the information into the college's financial aid system. It doesn't make you eligible for federal student aid. But the key there is to talk to the college financial aid administrator. Or just Google look on their website. They may already have an FAQ that answers that question.
Okay. Thank you, Mark. Next question. Will financial aid vary significantly from the first year to the following year if the income will not change a lot? However, this is a multiple part question. However, the financial aid has been appealed successfully the first year before entering the university.
So you must apply for financial aid every year. It's good for 1 year at a time. And except for that dependency override that I mentioned before, if you're appealing because of special circumstances, you have to appeal again. So for example, the 2024-25 FAFSA will be based on 2022 income. The 2025-26 FAFSA will be based on 2023 income. If there's a change in that income or there's a change in the family circumstances, you might need to appeal again. So maybe your income decreased, in which case you might want to appeal again based on that decrease in income. On the other hand, if the change in income was in 2023, and it may be that your FAFSA is going to be based on that lower income anyway, and you might not need to appeal again. But maybe there are other reasons for your appeal, like high unreimbursed medical or dental expenses, high dependent care costs for a special needs child or elderly parent. You should appeal every single year, just as you are applying every single year.
Thank you, Mark. Okay, next question. If family income changes significantly after submission, can filers make adjustments?
Okay, so the FAFSA is based on 2-year-old income information, which is not going to change. But if your family income has changed, and even before you file the FAFSA, so the 2024-25 FAFSA is based on 2022 income. What if your 2023 income has changed? Or maybe even your 2024 income has changed? You can and should appeal at that time. You can't change the FAFSA, the income reported on the FAFSA, except to correct an error. So it has to have been correct as of the date you filed the FAFSA. So maybe you reported your 2022 income, but had a digit transposition or added an extra 0 or 2. Then you can go in and correct that to be correct as of the date the FAFSA was filed based on that 2022 income. But if your income is now different, that's the reason why you should appeal. And then you provide the college with documentation of the reduction in your income, and they can decide to change the income on the FAFSA. You can't.
Thank you, Mark. Next question. Are you aware of any disadvantages to taking out a Parent Plus federal loan to pay for my child's tuition?
Well, the Parent Plus loan has a higher interest rate than the federal student loan. Like the new interest rates for the Parent Plus loan will be 8.05 roughly, and for the student loan, 4.5% roughly. So it is a more expensive loan. The federal student loans have annual and aggregate loan limits. So if you need to borrow beyond that, then the Parent Plus loan, as well as private student loans, may be your only options. But it's money that needs to be repaid, and you don't want to borrow too much money. And the kind of key issue here is if you're expecting the student to repay that loan, you may be having that student take on too much debt. You should aim to have the total student loan debt that the student's going to be responsible for repaying be less than their annual starting salary. If total debt is less than annual income, they can afford to repay it in 10 years or less. Now, if the parents are thinking, well, we'll borrow the money and we'll repay it, you have to consider how that debt compare for all your children, not just this one child, will compare with your annual income, and also when you're planning on retiring. If you're planning on retiring 10 years from now, then that same 10-year rule applies, and you should aim to have total student loan debt less than annual income, the parent loan debt less than annual income. But if you're planning on retiring in 5 years, you should borrow half as much. Also, keep in mind that you're the one obligated to repay the Parent Plus loan, not the student, and it's going to show up on your credit reports. So if you want to, say, refinance your mortgage to try to get a lower rate, right now the interest rates are much higher, but in a few years, maybe interest rates will drop. The lender is going to look not just at your existing mortgage and your credit card debt, but also that Parent Plus loan debt when they're looking at your debt to income ratio. They're going to say that is money that you're obligated to repay. You may say, well, it's for my child. Nope, it counts against your eligibility for refinancing your mortgage.
Thank you, Mark. Next question. Will scholarships or grants from the university affect the parent's income tax?
Okay, so scholarships, and financial aid, whether it's coming from the university or a private scholarship provider, are not going to affect the parent's federal income tax return, but they may affect the student's federal income tax return. If a scholarship or grant is used to pay for tuition and textbooks, book supplies and equipment, it's tax-free. But if it's used to pay for living expenses like room and board, transportation, or other expenses besides tuition and textbooks, it's going to be considered taxable to the recipient, the student, and will have to be reported on the federal income tax return. Now, students do have a pretty high standard deduction, around 12, 13, 14,000. So you'd have to have pretty substantial amount of grants and scholarships to reach that threshold. But once you do, it does lead to some taxes. And you can't use the scholarship to pay the taxes. So you may have to plan for it in advance, do a little bit of calculation to see if you're going to have any taxable scholarships and grants and what the tax liability will be. So you can plan to pay for it as part of your federal income tax return, which may be several months after you receive the money. Now, federal student loans are not taxable. There may be, and the interest may even be deductible. The interest on federal and private student loans up to $2,500 a year can be excluded from income on the federal income tax return if you're obligated to pay that interest. Federal work study is exempt from FICA taxes, but is subject to ordinary income taxes. So the financial aid may affect your tax liability of the student, not the parent.
Thank you, Mark. I've got two more questions, and I don't believe you've already touched on these, but let me know if you have. Does FAFSA require reporting of additional income such as inheritance? And if so, how does that impact awards?
Okay, so an inheritance, if it's received during that base year, that prior year on which the FAFSA is based, may count as income. However, it may count as untaxed income, which will no longer be required on the FAFSA. But to the extent that that money is unspent, it may be considered a reportable asset. That is, unless you move that money into a retirement plan or annuity, and now if you contribute it to a 529 plan, it'll be reported as a parent asset as opposed to a child asset, which has a lower assessment rate. But I've seen many cases where a student gets a life insurance payout when a parent dies or an inheritance, and that can have a significant impact on their aid eligibility. Structured settlements are sometimes better because of the way they interact, not just with tax law, but with financial aid law. I've written an article about them. It's kind of complicated. But an inheritance can affect aid eligibility. Now, we talked about the FAFSA. There are about 100, less than 200 colleges, I think 186 is the latest number, that use a supplemental form called the CSS profile form to award their own financial aid funds. Most colleges use the FAFSA for federal aid, state aid, and their own funds. But some colleges, especially some of the more selective colleges, use the CSS profile for awarding their own financial aid funds. And that has a harsher treatment. It may count money in retirement plans. It may count the inheritance and life insurance payouts as part of income, even though the FAFSA might not.
Well, thank you so much for everyone who attended, and for Mark for your time and your presentation.